Welcome back to another episode of Behind the Lens podcast with Roger Rojas. And today's guest is Anthony Pompliano. Man, thank you so much for coming on.
Absolutely. Thanks for having me.
So I want to get right into it. We were just laughing about it. You have a tweet pinned on your page saying, "My rules of business are build shit people want, never give up, avoid assholes, question assumptions, learn new ideas, and always reward ambition." That tweet was hearted over 24,000 times, retweeted over 6,000 times, and over 1,300 comments. Where did that come from?
I literally don't plan any of my tweets. I just was sitting there one day and I was like, what exactly do I think are the rules of business? And I tweeted it, and I knew that I was going to pin it at the top of my Twitter account. And so I tweeted, I think I pinned it like almost immediately. And I actually think with that tweet, I shut off Twitter. Like I just, left Twitter and came back an hour later and was like, whoa, did not expect that one. And then I've just left it there ever since. And it's kind of one of these things where I believe in, kind of people filtering themselves out. And so if you disagree with those things, you probably shouldn't follow me. And so that's why it's pinned right there. And so far, so good.
Yeah, and I want to touch on the subject line because they're all so, as I said before, blunt, but yet true. And the one that, for me, that came up to me was two of them: never give up and avoid assholes. I want to talk about the avoiding assholes. What do you mean by that?
Yeah, I mean, look, it's just life's really short, right? And I think that generally people, especially younger people, think it's do whatever it takes to be successful, right? And for me, it's just as you get older, maybe kind of you've got more experience, you just realize like, I want to work with people that I enjoy working with. And so if you're an asshole or you always make it difficult to work for people to work with you, I don't want to work with you. And I literally will make less money or be less successful in order to have more enjoyment in my life. And again, that's something that's really hard to comprehend when you're young. But just, as I've gotten older, and I'm only 32, so it's not like I'm some, old guy who's got all the experience in the world, but it's just over the last, 10, 12 years, like that definitely has kind of taken hold. What you find is like people who take that perspective tend to find other people who take the same perspective. Like if I don't want to work with assholes, usually the people I end up working with are the people who don't want to work with assholes either. And so it ends up, like-minded people kind of flock together.
Love that. And then we talk about never giving up. You've invested into over 100 million to early stage companies. And again, as I said on your Twitter bio, you call multiple unicorns. So I want to touch on that of what were those unicorns and what was that mentality with never giving up, especially when you're investing into a company that's just starting out, which is very, very high risk.
Yeah. So I probably take a very different approach to early stage investing than most people. One is I really don't care about the idea. Like I'll think through it and does this make sense? But really the reason why I'm spending any time at all on the idea is because I'm trying to better understand the person. And so like there's very few smart people that I know who have like completely asinine ideas. It's usually like, hey, I think that the market is developing a certain way. I think that somebody's going to build a company that does X, Y, or Z. I'm going to start doing that. And if I get new information, maybe I'll kind of tweak it here or there. But, I kind of have a perspective on the world. When you go through it and kind of game plan it and say, well, what happens if this happens? Or what happens if a competitor does X or Y? Like you can very quickly just unpack like this person is intellectually, one, very smart, two, doesn't have like rigid ideas, isn't willing to change. And also I think three, has an ability to articulate ideas in a way that will allow them to raise capital, to close customers, to hire employees and retain those employees and things like that. And so ultimately I'm just making a bet on the person. And there's great people who end up starting companies and they don't work. And then there's, frankly, bad entrepreneurs who end up starting companies and just literally the market takes over and they end up being super successful. But what you're trying to do is you're trying to find those great entrepreneurs. And so I think I've backed over 100 teams at this point. I'm almost positive over 100 teams. And you just over time realize that like it's all about the founder at the earliest stages because there's no other data, right? There's nothing to look at. And so that's proven to be a pretty good strategy.
You just touched on things that you look at for investments. What do you specifically look at for the founder? What are the questions that you ask him?
Yeah. So my favorite thing to unpack is like, and it's impossible to do, fully, but is this person going to quit? Right. Every company we've had that failed, for the most part, the founder quit. Right now, the founder might not have quit and said, just thrown their hands up, said, I'm done. But something happened along the way. They lost enthusiasm. They didn't go and raise more capital because they saw something in the marketplace. Like, just very, very often, and it's unfair to say every time, right? It's actually a good amount of time that's occurred. And so what you're really trying to underwrite is you're trying to underwrite the fact that this person is going to bash their head against the wall for 5 or 10 years, and they're going to keep working at this no matter how hard it is, and that gives them a shot. Doesn't guarantee that they'll be successful, but it gives them a shot. And so things that I look for are like, one, have you ever had hard jobs before, right? Somebody who's like, yeah, I've never worked a day in my life. Like, that's pretty scary, right? Because they understand what hard work is? Have they had to be persistent in their life before? I want somebody who's had a plethora of experiences as well. And that doesn't necessarily mean you've had to travel to every corner of the world or, come from some, unique life or family. It just means you've really taken the time to have those different experiences. And that could literally just be like, hey, you've read a lot. Right? It could be that you've consumed a lot of content on YouTube or whatever, but it's just getting that kind of diversification of information and experiences that ends up leading to a more holistic thinker. And then the third thing that I'm really looking for is I'm looking for somebody who can solve problems. And when I think about solving problems, I don't want somebody who always has the answer, right? The end result isn't as important as the process. And so what I'm trying to unpack is like, do they think from first principles, right? Do they have the confidence and conviction to actually talk about ideas that may not be popular or actually may go against conventional belief, but they have a reason for why they believe that? Do they actually sit in a conversation and can they argue both sides, right? Can they say, hey, here's what I believe, but here's also what the other side believes, and here's why I think that they're wrong, right? Those types of things are all data points that signal this person is kind of the right person to start a business. And then it culminates with like, is this person the right person to start this business? Right. So if I spent my entire life working on chemistry and then all of a sudden I, show up and I'm like, you know what? I'm actually going to start a construction business. I might not be the best person to start that company. Right. And so what you're looking for is almost this like founder market fit. Why is this founder the right founder for this business versus some other founder? And what that does is it really just kind of eliminates or filters out people who are being opportunistic and don't necessarily have the enthusiasm or the excitement and conviction around a market or an idea, which ultimately leads to, again, they're going to end up giving up because, they'll find the next shiny thing to go chase.
I think you brought up something that's very apparent and important is that the baseline is hard work. And at the beginning, everything's exciting. There's that sense of that quote, I hear it all the time. If you lead your actions by emotions, you'll always fail because it's not always going to be great. It's not always going to be exciting. When you're dealing with founders that are starting out their companies and they hit that roadblock, what are the type of conversations that you have with them? Aside from the emotional component of like, hey, this is what's going on financially, but what are the conversations you have with them? Because they also have to lead their own people, right? Because there's one thing being an investor and there's another thing being a CEO. The people within are looking up to. What are those conversations like? And what are things that you try to touch on that's consistent with every company you invest in?
Yeah. So one piece of this is like, I do the best I can with the experience and knowledge that I have. There's a lot of investors that have been doing this way longer than I have that I try to learn from them. Right. So I almost feel like a little bit of an imposter when I'm giving some of this advice to founders, and I have to remind myself like, hey, I've invested in over 100 companies. Like I've seen a lot. Yes, there are people who have seen more than me, but I've definitely done enough of the work to be able to kind of help some of these founders navigate these situations. And the first thing I remind them is like, your situation is not unique. No matter what you're going through, there's a bunch of other founders that went through the same thing. And in many cases, the thing you're worried about is so small compared to the problems other people have had to face that basically like, you got to chill out, right? And you got to understand that your number one job is to control your emotions and to show leadership to, the people that are following you. Because if they lose trust and kind of confidence in their leader, then you're going to lose them. And I think that's a key piece is like, one, if you want to have a conversation because you're nervous, you're scared, you're upset, whatever, call me. don't go and have that conversation kind of, with the low-level employee or entry-level employee, because what you're going to do is you're going to change the culture of your business. And so I think that understanding that as a founder, like who to call when, sometimes you should call your investors. Sometimes you shouldn't call your investors and you should call your, co-founder. Other times you shouldn't call the co-founder. You should call literally an executive coach, right? Other times you should go talk to your actual employees or talk to your customers, and like having that kind of emotional intelligence to know what to talk about, but also who to talk about it with is really important. And then I think the other piece of this is just everything is solvable, right? And sometimes you get this feeling of like the world's ending, like my company's going to go out of business, whatever. Everything is solvable. It may not be easy. It may not be immediately obvious, but everything is solvable. And so you may have to make the best decision out of two bad decisions, but it's still, there is a solution to every problem. And when you have that mentality of like, I will solve this, I don't yet know how, but I will solve it, immediately you go from defensive mode of like, the problem's happening to me and I don't know what to do. And I'm just like taking punches. So I kind of think of it like a boxer up against the ropes and just like, there's getting wailed on, to, okay, there's a problem, I'm going to solve it, right? Now you're in control. You're the one moving in across the ring. You're the one delivering the shots. And like, sure, you're not going to have the knockout punch. You're not going to have the solution every time, but understanding that like the only things you can control are your actions and the way that you and your team respond, put you in an offensive mindset rather than a defensive mindset. And I think that's really, really important because it allows you to, one, to control your emotions, but also two, to start to exert your will on the problem. And for whatever reason, psychologically, like that's just a better position to be in than, kind of just, hey, the world's crashing around me and I don't know what to do.
Yeah, I think the biggest is understanding that being a leader, right? And I love how you brought up emotional intelligence of having certain conversations with certain individuals, because you can't have that all the time. I think that's an important lesson to know and have, is where certain things you can't say to certain people. As a CEO, you shouldn't be going into the coffee room talking to the intern about how you're feeling with the biggest issue at hand, when one, they can't do anything about it, even though they're listening. They really have no kind of framework to give you a solving answer to the problem. When you first started investing, what was the first company you invested into?
Oh, man.
Or even top five. It doesn't need to be the first. How long ago was that?
I'll tell you a really great story, though. On the first company I should have invested in but didn't. I'd never made an angel investment in my life.
How old were you at the time?
Won anything. I was 20, this is in 2014. So I was like 26 maybe. I was working at Facebook. A friend of mine or a colleague at Facebook had been an angel investor in DoorDash. And basically the head of growth, I think at the time at DoorDash, was like, we ran all these growth teams at Facebook. We're supposed to be so smart, whatever. So they came over and we were talking about all kinds of stuff. And this guy was like, hey, you should talk to these guys. And I can't remember all the details, so I don't want to kind of misspeak, but like, I think they were either just finishing up the seed round or going to raise a Series A, or there was some opportunity of like, hey, if you want to have a conversation about investing, like we'd be open to that. And I was like, why would I do that? Like, we're Facebook, like all this stuff.
I want to touch on instinct. Why? Like what?
I didn't know. I didn't know the game. Like I didn't understand the idea that I could give money to a very small company, and if it was the right company, it would grow. Like I literally didn't understand what angel investing was, right? And so I just was like, basically looking at my buddy, like, why'd you give me? Like, that was dumb. Like you could go to Vegas and like just gamble, you know what I mean? Like I just, it didn't hit me. And it was a lack of knowledge, right? It was a lack of understanding, one, why somebody would do that. Two, the potential return profile, how asymmetric early stage investing was. And then three, also, I think it was a sense of like, I was still young. I didn't have a ton of money. So I like was very not critical, but just like, yeah, I was just careful, I think. Right. And so it kind of led to this like paralysis by analysis. I was just like, whatever. And then I got busy and just never thought about it. Well, like, as people know, like DoorDash is a multi-billion-dollar company now. And like, that was pretty stupid. But it was a great lesson, because what I got to see was, what ended up being early employees or co-founders, I can't remember, of a company that ended up being a multi-billion-dollar business, and seeing what they were talking about at that time. And like, I think they would probably say it like, they're way better today than they were then. It's not a knock against them, right? It's just like they have years of experience now. They've went and they've learned, they've kind of cut their teeth, right? They've built that muscle memory. And so I think that like those types of experiences are really educational. But then what I did was like, I started asking questions. I started going and finding people that were investors in early stage startups and saying to them, hey, why are you doing this? How does this work? All that kind of stuff. And then so that was 2014 or 2015. By 2016, I think 2016, I was starting to raise a fund, right? And doing it full time. And so like the learning curve was steep, but once I kind of said, hey, like this is super interesting, I went really hard at it. And, here we are kind of 4 years later or so, invested in, over 100 companies. And, frankly, think I'm pretty stupid for passing on that and a lot of other companies I passed on. But at the same time, we've got some winners as well. So, just constantly learning, how to get better at it.
I want to talk about your winners. So as I said in your Twitter bio, you have magical unicorns. Who are those unicorns?
I don't think I could talk about all of them.
Yeah, no, you can just give one, and I think I would love to hear context.
Okay, so I'll give you one. One that just announced that they raised it over $1 billion valuation is a company called Everly Well. Basically, this woman, Julia Cheek, she was I think Harvard Business School graduate, lived in Austin, Texas. She had this idea of taking at-home diagnostic testing. So think of, they ship you a testing kit. You like prick your finger or do whatever the test is. You send them back the results. They, analyze them, and then they tell you via digital communication, like, hey, here's the results of the test. So this is like food sensitivity and all kinds of stuff like that. She was raising money at a seed-ish round, pretty low valuation. She got
for context for listeners, because again, most of them are young. Can you explain that process? So what that means and everything that comes into that?
So she had started a business, and she basically knew that in order to grow that business, she needed money. And there's two ways to get money. Is one, you can go get money from your customers, basically sell them something and take their money and use that for operations. Or you can basically sell a part of your business, earn money that way, or raise money that way, and then use that to fund operations. But when you sell a part of your business, you're basically giving ownership to somebody else, right? Or a piece of ownership to somebody else. So that's what she was doing. And basically what you do is you try to figure out, okay, I want to sell, let's use easy numbers. I want to sell 10% of my business for $1 million, which means my business can be valued at $10 million, right? And so she was doing that. We put what ended up being a pretty small check. I think we invested like $50,000 in her company. And fast forward now, she literally went from kind of a very early low valuation. I think we invested at like a $15 million valuation to today. She last raised money at a $1.3 billion valuation. And so when you look at that, you're like, how does that happen? Well, one, she built an amazing team. Two, she knew what she wanted to build, and she stayed disciplined and patient and really went after it aggressively, and ended up being successful doing that. And then three, she was a great founder and was very opportunistic along the way. When COVID happened, she raced, and she was either the first or one of the first companies in the United States to get approval for an at-home COVID test. And so that explosion of revenue there. And so you can just see, like, she knew what she wanted to do. It was obvious that she was really, really set on doing it. We thought that she was going to be a great founder. We invested in her. She built this team. She built a product. She executed. And then when opportunity presented itself, she jumped on it, ended up kind of furthering the business or accelerating the business. And today she's a company that's worth $1.3 billion. And the crazy part is we made that investment 2016 or 2017. I can't remember. Right. But like, we're talking about in a span of 3 or 4 years. She's literally taken a business that was valued at $15 million to $1.3 billion. And so it's like, being long innovation and long entrepreneurs ends up being pretty profitable when they do what they, what they potentially can achieve and build successful companies.
Two-part question. So one is obvious, because of the valuation being however times from the moment you invested, due to you, one, sticking to that, the amount that now you gain is a lot higher, right? Correct? Second part is it typical that throughout that process, because I'm sure there was other rounds, right, between the time you invested to this evaluation, as an investor, are you capable or able to pull out? So or is there maturity dates on that?
Yeah. So every deal is different, right? There's kind of three things that you can do in these rounds. So, and there's a whole bunch of things that like legally you're allowed to do. And then also there's like, I'll call it like social construction around what you're supposed to do, right? So nobody wants somebody to invest in their company in the first round. And then when the second round comes around, they're going to give me my money back plus all the profits. Like that's a bad partner, right? So like,
yeah, but that's something that can happen, and it does happen, correct?
It depends. It's very, very rare because founders and other investors are smart now about the way that these documents are usually structured. Usually that doesn't happen until later rounds, all that kind of stuff. But in this particular, or just in general, so if you invest in an early round and there's future rounds, you can do one of three things. You can do nothing, right? Which basically means whatever is raised is raised. Two, you could try to sell your position, right, to a new investor. There's details around it, whether that'll be a good thing to do or a bad thing. Or three is you can try to buy more of the company. And so early on in my career of investing, right, which is 4 or 5 years ago, I didn't understand this. All I did was I would just make the initial investment. So Julia's a great example. Invest $50,000, bam, it takes off, home run. Like we're geniuses, right? Like, woo, high five my partner and like game on. But now with the knowledge that I have, we should have invested as much money as possible in every single round after that, because if she raised, and I forget what she raised money at in the future rounds, but let's just say she raised money at, 100, 200, and $300 million valuations. Each one of those investments would have been up 8 to 10x into the new valuation. And the reason why there was a higher valuation at that time was because it was actually de-risked. It was a less risky investment than the investment we made at the $15 million valuation. Right. So there's this kind of balance between that you get access to a higher return. There's more asymmetry in the investment, the more risk you take. But if you took the riskiest opportunity and you invested and it's working, there's this saying that like the best investors in the world press their winners harder than everybody else. You should be piling as much money into the company as the founder will allow you to, and that you have capacity to do, because the winners in venture capital, it's such a power law that the winners are going to pay for everything else. Right. So if you look at some of these funds, I think, Sequoia, some of their returns got published recently. And I think that they have funds, they were up like 8x, 10x, and 11x on hundreds of millions of dollars in their funds. Wow. It's pretty serious stuff, right? But guess what? They didn't just make a single investment, right? They made a single investment and then and the next round doubled down and doubled down and doubled down on the company, because the companies end up being so successful. And so again, didn't understand in the beginning, learned that, and in future investments started to leverage that to build bigger positions and frankly give a bigger return to our investors.
That's amazing. I want to get into the next part of who you are and kind of how I always see you on the news, Bitcoin. It was a big topic early 2016, right? It was like, I felt like everyone was talking about it. Everyone was dumping money. There was winners, there was losers. But you still today are on the news talking about it. And just a couple of days ago, it was like an all-time high. Before I continue, I want to make it clear, we're not giving any financial advice. You're not giving any financial advice. It's simply education on the topic. And more so, you're an individual that clearly has a deep understanding of it and also is well rehearsed in it on understanding what it is and what it does. For those who don't know, I would love for you, what is Bitcoin? And also I would like for you to bring up a blockchain. I think those are two very, very important things.
Yeah, so Bitcoin is basically, just think of it as digital cash, right? And if you think of the US dollar versus Bitcoin, for example, they're basically 180%, 180 degrees different, right? And what I mean by that is the US dollar is inflationary, meaning that there's constantly new dollars being put into circulation. And those decisions are made by humans at the Federal Reserve and our elected officials. And what that does is it devalues the dollar. So if you think of, why was gas, it used to be 25 cents, 50 cents a gallon. Now it's $2. It's not because the gas got more valuable. It's because the dollar got weaker, right? So the dollar's lost like 99% of its purchasing power over the last couple of decades. And so when you start to think about that one system and you compare it to Bitcoin, Bitcoin's the exact opposite. There's no unlimited amount of supply. There's only going to be 21 million ever. It has something called a disinflationary monetary schedule, which just means that it's constantly putting new Bitcoin into circulation, but every 4 years that amount drops until eventually it'll be no new Bitcoin being put in. And then what you get is, rather than it being devalued over time, Bitcoin has actually been incredibly aggressive in its appreciation, right? But the question is like, is it because Bitcoin's getting more valuable, or is it because the dollar is getting devalued against it? It's probably a little bit of both. And so when I think of Bitcoin, basically think of the same reason people tell you to buy a house, right? Why do I tell you to buy a house? It's the greatest investment you could make, right? Buy real estate. Well, it's because real estate always goes up, is the saying. The real estate didn't get any more valuable. It's that the dollar keeps getting devalued. And so if you sit with your dollars in your bank account, if you have $100 today, 5 years from now, that $100 can't buy you the same amount of stuff it can buy you today, right? Literally, the prices of everything continues to go up. And the joke is always like, think of the things in your childhood that you would pay for, and then go look at the prices today, and you'd be like, how does it 2 times more expensive than I used to think it was? Well, it's because the dollar's being devalued and you're losing purchasing power. So the sad part in the United States is 50% of Americans, the bottom 50%, own no investable assets. It means that they get a paycheck, they live paycheck to paycheck, and all of the money that they have sits in a bank account. That's it. They have nothing else other than just cash. Well, as that cash is sitting there, it's losing value. It still says, if you put $100 in, it still says $100, but that $100 can't buy you the same thing. And so this is the whole phenomena of the rich get richer and the poor get poorer. It's because the rich understand, right? It's not a money thing. It's an education thing. They understand, I'm not going to leave my money in cash. I'm going to take it and I'm going to put it into other assets. I'm going to invest it. So they buy stocks, they buy real estate, they buy gold, they buy Bitcoin, they buy whatever, right? But when they do that, what happens is the dollar keeps falling and those assets stay the same. And therefore, on a dollar basis, the assets go up in value. So it takes more dollars to buy that same asset in the future than it did when they invested. So they, quote unquote, make money. And that is ultimately the whole thing about, just financial education in general is like, get the hell out of sitting in cash. You should have enough money for kind of a rainy day fund and then invest. So your money can grow. But also that's the whole idea behind Bitcoin is basically Bitcoin has provided this new monetary policy where people don't have to save in dollars. They can save in Bitcoin and it protects their wealth, right? It's kind of sound money principles, kind of what gold has done for decades. And what we're seeing is literally tens of millions of people around the world are electing to do this. And it's pretty exciting. And so I think that we're going to continue to see that trend, go in the same direction for the years to come.
Would you say Bitcoin, because of the relevancy of it being cool, helps out the market? Because there's a lot of, I think right now, in my opinion, and correct me if I'm wrong, due to COVID and the timing, we're going to see a lot of generational wealth moved around. And also due to social media, like yourself, you have a podcast with Josh Richardson, these young teenagers with an influx of cash. They're like, how can I get it out there, right? And it seems to me that Bitcoin, aside from people like you, could be the cool thing to invest in. And by that, of course, like anything else, it'll raise the price of what it's going for. Do you believe that plays a big component with it today?
Yeah, I tend to think that the cool factor comes from young people, and young people aren't doing it because it's cool. They're doing it because they understand innovation better than older people. Right. And this is a generalization. So there's a lot of nuance here. There's definitely examples that are counter to it. But in general, young people understand technology and innovation better than older people. Right. And a perfect example is like my generation grew up. We got our first cell phones in high school. Right. The generation below me got their first cell phones in middle school. The generation below them started in elementary school. Right. And so like just take those 3 generations of kids. They grew up with cell phones in their hands. Right. And like, I literally remember I was the tail end of kids who, when I was in high school, I couldn't get a Facebook account because you needed a college email. And then I remember like getting my college email and being like, yeah, like I'm on Facebook, right? So stupid, right? And so I think that like, even though that happened, now there's kids that are, 15, 16, and they're growing up with all these social networks and they got a plethora of them to choose from. They're going to understand digital technology better than me or somebody older than me and things like that. And so I think that's what really drives a lot of this is like, if you ask young people, I asked my brother, actually, he's 24 now. I think I asked him when he was like 22 or 23. I said, hey, do you know what a bank wire is? Have you ever sent one? He's like, what's that? Right. And I was like, oh, you like go to the bank. He's like, why would I ever go to the bank? And I was like, he's like, other than to go to the ATM. And I was like, okay, fair. I was like, well, how do you send money to your friends? He's like, oh, two ways. I use Venmo and I use Uber. And Venmo, I expected, right? I use Venmo, whatever. But I was like, Uber? And he was like, yeah, like when I get in a car with my friend, we split the ride at the end. And I was like, wow. I knew that feature existed, but I never thought of it as a way to send money to my friend. And so it was just like that little thing was so obvious to me. I was like, damn, am I old already? Like, am I already like getting, too out of this? And so it's just this thing of like, even when you're aware of, let's say, a feature or a product, you may not have the framework to evaluate the same way that somebody else does who's more familiar with the technology. And so, one is like, if you're young, use it to your advantage. But two, if you're older, like one of the best things to do is go hang out with a bunch of young people, because they'll keep you abreast of what's going on and how they think about this stuff.
It's so important because it's staying relevant, because things are moving so fast with technology and such. What are some financial habits that you took on that you believe helped you save money, and then more so take that next step of being able to invest and find these companies? Because me personally, I'm 26 years old, and I had the financial education talk with one of my good friends who's in the banking world, and we literally sat down, taught me about 401k, stock markets, ETFs, all those things that, in a way, family, it's almost like taboo talking about money. Right? I believe it's reverse psychology. That should be spoken about, because people feel that way because they're not educated enough on it, where it makes them feel uncomfortable. What are some financial habits that you believe that worked for you that others could take on, that are even small ones? Because again, someone like yourself, when a listener's listening to this, even me, where you're like, all right, I don't have hundreds of thousands of dollars to just be investing. Yep. But I believe it's the little things you do today that help for tomorrow. Forget the Starbucks coffee. Do that for a week. You have $50. All right, throw that into getting, something, right? So what are those habits that you recommend when it comes to financially taking that next step?
Yeah, so I'll give you, I kind of have these 5 rules of personal finance, right? So the first is you got to spend less than you make, right? And that sounds real simple, but literally, like, that's step 1 is, if you make $50,000 a year, you got to spend less than you make after taxes, right? If you make $20,000 a year, you got to spend less than you make. If you make $2 million a year, you got to spend less than you make. That is the number 1 key, is you got to live within your means. The second thing then is you got to get out of debt. So a lot of young people are probably listening to this and they're like, damn, I got a lot of debt. I got to pay this stuff off. And so, I come from the school of thought of like the Dave Ramsey of the world, of like, do whatever it takes to pay off that debt as fast as humanly possible, because it literally is just taking money from you the longer that it persists out there. And so, he's got this saying, I think, of if you're in debt, you shouldn't see the inside of a restaurant unless you're going to work there. Right? Like that's the mentality. Like, it's literally,
that's a good one.
Like I think he calls it rice and beans until you get the debt paid off, right? Like that's the mentality you got to have so you can pay it off. Because then once you pay it off, now that money that you're saving by living within your means isn't going to pay your debt. Instead, now it's going to your bank account. Mm-hmm. And so the key to this is, 1, get rid of your debt. But then the next thing is you want to have multiple streams of income. We spend a lot of time with people saying, hey, you should try to figure out how to save $300, right? What I always tell everyone is like, okay, so if you want me to save $300 in my monthly budget, a lot of times people aren't out buying Ferraris, right? Like they're doing something else. And so to spend, save $300, I can't go to the bar with my friends. I can't go to the movies. I can't go buy that, gift for Christmas or whatever it is. But is it easier to save $300, or is it harder to just go out and make an extra $5,000 this year? A lot of times it's actually easier to go make the $5,000 than it is to save $300 a month. And so if you have that mentality of like, I'm going to cut my costs and I'm going to increase my income all at the same time, that's where you really start to, start cranking on your income. And so in that situation, having multiple streams of income, not only 1, increases your overall income, but 2, it diversifies your risk, right? You're not, if you lose your job, you're not out of making money. Now you've got other things in the works. So, it's live within your means, get out of debt, make sure you got multiple streams of income. Then the 4th one's real important. Invest. Saving is for losers. Investing is for winners. And that is a societal thing that we told people, save, 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 save. You should save enough money to live for a month, 3 months, 6 months, whatever you're comfortable with, right? I call it like the rainy day fund. You should have enough money sitting in a bank account so that you can live for X period of time that you're comfortable with if you lose your job. After you hit that number, you should invest all the money. And you should be smart, you should be conservative, you should do all this stuff, but you have to put your money to work for you. And the reason why I say that is because you're not going to get rich off your salary. It's not going to happen. Instead, what you're going to need to do is you're going to need to live within your means, get out of debt, have multiple streams of income, and then grow your money for you. And so what people hate to hear is if you make $50,000 a year after taxes, after expenses, if you're able to put, I think it's $100 a month away, and you invest in the S&P 500, and you continue to do that every year for 30 years, given the historical trend of the S&P, you'll end up with a couple $100,000 at the end. And that's just $100 a month. That doesn't include other investments you make, etc. So I always tell people, like, anyone can be a millionaire, anyone, if you follow these rules. But the key to doing it, which is the fifth rule, is you got to be persistent and you got to be disciplined and patient. So you got to stay on top of it. You got to do the right things. You got to live within your means. You got to invest. You got to get out of debt. You got to do all these things, but you got to have a long-term time frame. And so that leads me to this new concept that I recently heard that I'm infatuated with, which is this idea of a time billionaire. So everyone thinks in finance about billionaires being dollar billionaires. I have $1 billion, right? That means that I'm rich. That means that I'm able to use my resources, whether they're financial or my network or my influence or whatever, to get richer, right? And therefore I'm wealthy because I have $1 billion and I can buy leverage. I can buy employees. I can buy time. I can buy, machinery, whatever, to grow my wealth. But if you look at a time billionaire, what if we measured wealth in the seconds that you have in your life? So if you think of 1 million seconds, that's about 11 days. If you think of 1 billion seconds, that's about 31 years. So 1 million seconds is 11 days, 31 years is about 1 billion seconds. And so you start thinking like, okay, and there's this guy, Graham Duncan, who talked about this on the Tim Ferriss podcast. And what he basically was explaining was, he was like, why do we only celebratize the dollar billionaire? The time billionaire, right? If you're 20, you probably got 2 billion seconds left in your life, right? With modern technology. And so if you think about it, which would you rather have, $1 billion or 1 billion seconds? Well, let's think about it. Would you at 26 switch lives with Warren Buffett? You'll be one of the top 5 richest men in the world, but you got to be 90 and you're likely to die in the next 5 or 10 years. Or would you rather be 26 with your whole life ahead of you, right? Most people actually would choose to be 26 without the money. And so you are wealthier than Warren Buffett in that sense, because you're not willing to switch places with him. He would likely be willing to pay a lot of money to switch spots with you, right? And so the reason why I bring this up is this idea of a time billionaire means you do not have $1 billion in financial resources. You're not a dollar billionaire, but you're a time billionaire. And when you're a time billionaire, use the advantage you have. Use your wealth or your resource. Invest for the long term because you have time on your side. And so what you're able to do is say, okay, I need to put $20 away a month, $50 away a month, $100 away a month, whatever the numbers that you can get to. Every single month, super disciplined, and think about it for 30 years. And you'll end up with millions of dollars at the end, right? If you're really disciplined, you increase your income over time, you're able to keep increasing the amount of money that you're investing, and you do it in a safe, conservative way that works out over a long period of time, you will end up being a multimillionaire. And the whole key to it is nobody wants to do that because they don't want to get rich slow. They want to get rich tomorrow. And so it just comes down to understanding, like, I got time, and the people who have money would switch with me in a heartbeat. So why don't I stop complaining that I don't have money and instead focus on the time advantage I have and use that so that I can get wealthy?
Mic drop. that was it. No, that's it. The Warren Buffett metaphor. That's it for me. That's it. I appreciate you. I appreciate your time. Where's the best place where people can follow you? And please let them know about your podcast.
Yeah, I would say Twitter's probably the easiest place, just at Pompliano. The podcast, Pomp Podcast, you can just search for it, YouTube or the various audio platforms. And then I write this email every day. It's just pompletter.com. where basically I try somehow to break down all this complex stuff into everyday English for people. And so far, so good.
Love that. Pompletter.com. I'm going to sign up for that. So I didn't know you had that.
Send me your
So,
email.
all right, I got you. I'll email it to you. Thank you so much for coming on.